What is going on, traders? Huge news rocking the financial world today that we have to talk about. SVB Financial is down 60% today. Now, if you're not familiar with this bank, it's a regional bank in Silicon Valley that lends mostly to venture capital-backed startups. And despite its perceived size, it's actually the 16th largest bank in the US. Now, why should you care about this? We're going to get into the reasons why. And it may have implications that this is the first sign that we are approaching a dangerous recession. So we're going to talk about the reasons why that bank was down 60% today, why that led to ripple effects among all banks, small and large today, as XLF is down, and almost every single regional bank is down big as well. And then we're going to get into other signs that are starting to pop up that signify we are probably close to a recession. Not only do we have the banks, but small cap stocks took an absolute beating today. And then the yield curve inversion is worsening. This is the worst 10-year, 2-year yield curve since 1980. I'll give you an update of why I pulled out of the stock market. And then towards the end of the video, where can you put your money for safety at the moment? The S&P 500 down to 3,900, still really haven't broken a pivotal level to be considered dangerous, although we are now back into the neckline of this inverse head and shoulders. For those of you that follow this channel, you already know this. And we have the all-important jobs report coming out tomorrow as of the time of this recording. We have CPI on March 14th and FOMC on March 22nd. So much to get into. Let's just get into it. All right, so as I said, SVB is down today 60%. Now, here is why it dropped and why this has to do with the Fed and why you should be paying attention to this, even if you don't have any money with SVB. I don't. But SVB announced that they were forced to sell all of their securities that are classified as available for sale. They basically have a portfolio that is comprised of U.S. treasuries and mortgage-backed securities. $21 billion is the total amount, and they were forced to sell it off in order to not avoid burning through their entire cash stash. And they took a loss of $1.8 billion. Now, that is not only what they did, they also had to raise more money by doing a convertible preferred and common stock raise in the amount of $1.25 billion, and then raising some more in the total amount of $2.25 billion, which includes private equity lending. Now, in fancy speak, all that means is that they were forced to sell all of their treasuries to avoid going bust, and they were forced to raise money through the stock market as well as private equity. Now, here's the important part. This has to do with what the Fed is doing. So we are finally starting to see the interest rates affect parts of the economy. Look at this. It says, what we learned over the last 12 to 24 months is that in a fast-paced rising rate environment, customer deposit dynamics are different than what we had expected. So we are seeing this across the board where deposits are actually down, but deposits are down because now treasuries are starting to look attractive. Why would you keep your money in a bank if you can get 5% on a 3-month treasury? And if you are going to attract customers, well, if you're a bank, what are you forced to do? You are forced to now raise your interest rate to attract more depositors. But if you are raising your interest rate, then that means that you are making less on loans that you pay out. Because remember, banks use your money in order to lend out money. So they have to lend out money at a higher rate than what they're paying depositors. But now if they're raising the interest rate that they have to pay depositors, then they make less money on the loans that they give out. And not only that, but banks like SVB, which are heavily involved in venture capital-backed startups, obviously means that those startups are also now hurting because of the rising interest rates. Remember that rising interest rates affect growth stocks and startups quite a bit, as well as small caps. They do also obviously affect mega caps, but mega caps have the capital, the revenue, usually the cash flow in order to sustain rising interest rates. They don't like it, but their survival is usually not on the line as it is with regional banks, with startups, with hyper growth stocks, with small cap stocks, etc. Now, this is part of the reason that we shorted the living crap out of QuantumScape, a hyper growth meme stock that rallied 33% on earnings, making this inside buyer here the following day. We shorted it at $10 with our stop above this, which to me was pretty safe because in my view, if we're making an inside bar above this 33% candle, there's little chance that we get above this. So I had a stop limit at 12. We are still riding the short. We are up 27% on this short. Also had a ripper of a NASDAQ short today from this level here. This eventually ended up being a 5-to-1 trade. and I missed my entry by one tick, hence the crying face here. But before we move on, because I want to talk about the rest of this as it is really important, showing that what the Fed is doing is starting to hurt the economy, and this might be the telling signs of a recession. Before I get into this, if you guys want access to all of our trades, all of our short-term, long-term, our short stocks, futures trades, options, etc., our long-term analysis as well. What was my reasoning for buying stocks back in October? As I said here, back on October 18th, we're at a 50% retracement level from the previous bull market. And why did I actually start selling stocks on February 6th? I also made a video about this where I was clowned a bit for that, but those comments are now being deleted by the brave commenters. Click the link in the description. Join our academy today. You also get access to all of the mastermind calls that we do, as well as all of the course videos that we have, 60 plus videos of courses, how to day trade, how to trade options, etc. We are on every single day from before market open until after market close. All right, let's move on. Small cap stocks taking an absolute beating, yield curve inversion worsening. Again, to me, these are the signs of an impending recession. The Russell 2000 down today almost 3%. This is the most out of any index. And again, the difference between the 10-year and the 2-year at the worst level since 1980 at negative 1.07. If we go all the way back to 1980, you can see that that was the only other time in history that we actually went below 1. And so in, 42 years, 43 years, this is the worst yield curve inversion ever. The bond market absolutely believes the Fed. Fed Fund Future is now predicting that we will hit the highest rate in August of 2023 at 5.52%. And here you see the banks taking an absolute beating here. This is the worst day on the XLF, which is the S&P 500 banking sector, financial sector, down 4%. I don't remember the last time we had a minus 4% day. It actually might have been during the pandemic. This might be the worst day since February 2020, right before the lockdowns and the shutdowns happened. So, this is not an anomaly. This is due to fears that what the Fed is doing is actually working. And one of the first casualties of the higher Fed funds rate is going to be bank stocks, not only because you have that deposit risk, but there's always, obviously, especially after 2008, there's always obviously a fear of a credit risk. And another thing that I found terrifying, this is from a Twitter user called Black Swan. If you look at this, the consumer loans is in blue and the personal savings is in red. And at the start of the pandemic, when we had all of that helicopter money, you had actually a lot of people with money in their bank, right? And then all of a sudden, you start to see consumer loans, credit cards, other revolving debt climbing, and the personal savings dropping. So this right here is a very scary inversion. I'm not sure historically if this has led to a recession, but certainly not something you want to see in conjunction with all of the other factors that I talked about before. So again, on February 6th, I made a video titled Why I Pulled Out of the Stock Market. And if we take a look at February 6th, you could see here that this was near the top of this rally. It was actually right around here. And I pulled out of there. Obviously, technicals have something to do with it. You could see here on the SPY chart, self-explanatory. But also because we had rallied so much in a lot of the meme stocks, the ARK funds, DocuSign, etc. Those stocks had rallied so much in the face of what was now upcoming catalysts. We had the CPI revised higher 4 out of the last 5 times. We had the Fed finally saying that they're going to go higher for longer. Some Fed members saying that they see rates at above 5.5. Some even saying that they see rates at 6. The bond market started believing the Fed. The Fed Fund Future started believing the Fed. And it looks like the only laggard was the stock market. So, in the face of so much uncertainty at that time, we had another CPI to come. At the time of all of that uncertainty, to me, we were technically in a toppy situation. And then fundamentally, I did not like the way that things were looking with the revised CPI, with the Fed speaking more hawkishly with Fed funds futures and with bond investors betting that the Fed actually goes higher, with the yield surging. It just, to me, all of the gains that I got from buying in October were too good to pass up, and I wanted to lock those up. And then obviously, as I said, bond yields were rising like crazy. And so at that time, and even now, I mean, and this will lead to our last point here. Where can you put your money for safety? If you look at the S&P 500 earnings yield, you are now getting a better yield from a risk-free treasury. So a 3-month treasury pays you 5, 4-month 5.1, 6-month almost 5.3, et cetera, et cetera. The S&P earnings yield right now is around 4. And so you're getting a much better yield in a risk-free rate rather than investing in a risky moment in a risky asset class. So for me, this right here is where I have put my money after I had pulled it out of the stock market. Now, if you pull your money out of stocks and you say I'm just going to put it in a Vanguard S&P fund and not look at it for 30 years, that's fine too. But for me, I like to take a more active approach to my money and manage it a lot closer. So there's no way that I was surpassing these risk-free rates for such short-term treasuries. Now, if you want to invest in treasuries, and I have no skin in this game, you can obviously do it through your broker. They will likely charge you a fee, especially if you're doing it over the phone. But you can also go to treasurydirect.gov. Again, I have no affiliation with this site. It's actually a government site. But if you go to treasurydirect.gov, you can open up a free account. I believe you have to be a US citizen, but you can open up a free account and start taking a look at, start playing around with this. Take a look at treasury bills. There's obviously tutorials on here showing you how to buy them, but you could buy treasury bills that are, 1 month, 2 month, etc. And start looking up the tutorials here. How do I buy a bill? How do I buy a treasury marketable security? You are either going to have to buy it at an auction, which you can look at the auction dates on this site and see when the next auction is on the auction calendar, or you can buy them in the open market. Because remember that when you buy treasuries, you can sell them on the open market just like any other asset. There are some restrictions depending on how long your treasury is. So if you buy a long-term bond, I believe you have to hold it for 45 days before being able to sell it. But you can either buy it on the open market, or you can buy it when the auction dates are. And again, you can look all of this up on treasurydirect.gov. It is a government website. These are risk-free because they're backed by the US government. And for me, at this moment, while I'm awaiting all of this mess, is a lot more bang for your buck. Now, obviously, we have the jobs numbers coming out. We have a few other catalysts coming out as well. If those catalysts are supportive of now I don't believe we'll have a soft landing, but if those catalysts in the short term are supportive, meaning that it looks like employment is trending down finally, it looks like inflation continues to go down on March 14th and doesn't come in higher. And if the Fed does a 25 basis point rate hike and doesn't get aggressive with a 50, then we could see the market just teeter around for a bit, or even revisit these highs that we saw back in early February. But for me, things are just too uncertain to take that much risk. And I would rather wait for a revisited low, such as, around 380 on the SPY. If things get really bad, I do believe we can revisit those October lows. But for that to happen, in my view, inflation has to show that it's coming back and not, continuing to decline. So if a year-over-year number comes in higher than expected, or even higher than a previous month, then I do believe that we can eventually shoot for those October lows, especially if the Fed continues to raise well into the summer and take us above 5.5%. But the good news is that I do think this year, by the end of this year will be the end of the worst, in my opinion, for this situation, right? The only way that we don't get there is if the Fed puts its foot on the brake and we have a situation like we did in the early 1980s where inflation comes back roaring. But I don't think that they will make that mistake. They have already shown their willingness to be hawkish in this scenario. Anyway, traders, that is it for this video. Hopefully you got something out of this. Hopefully, you understand some of the risks associated with an upcoming recession, or some of the signs associated with an upcoming recession. The banks some banks being at a risk, just like SVG. What was that bank called? Sorry, SVB Financial. So we are seeing, some of the initial signs of a potential recession here. Anyway, if you got anything out of this video, leave it a big fat thumbs up. Let me know in the comment section below. What do you think of the potential risk to SVB Financial as well as risk to smaller banks and larger banks? Do you guys see that as a sign of an impending recession? How are you guys invested at the moment? Would love to hear from you. If you want access to all of our trades, analysis, courses, mastermind Zoom calls with me, link is in the description below. Sign up. You will know very shortly if you were approved. And if you're approved, I will welcome you to the Traveling Trader Academy family. Would love to have you. Subscribe to the channel. Hit that notification bell. Stay safe out there, traders. Peace.